Roll up, ladies and gents. Part 2 of the Designing a Customized Day Trading Playbook webinar. Hope you're all well. What time are we? Just after 6. Good. Everyone's rolling in. We've got a capacity of 3,001. I don't think we'll hit that today. Maybe we will at some point, but I don't think we'll hit it today. Hey, listen, thanks for coming here. I appreciate your time. I know there's loads of things you could be doing. You've probably got the markets on one screen. You're probably watching the NASDAQ rip as we speak. Maybe you're trading the yen. The yen's a bit spicy at the moment. But I'm glad you're investing in a little bit of knowledge. And I really hope today that I can give you something that's going to help you level up your trading. Just get over a hurdle. Just think about things differently. Frame things in your mind. Declutter a little bit. That's the whole purpose of these webinars, guys. Those of you who haven't seen me before, my name's Mark Holstead. I've been trading for a couple of decades plus, and I've got some knowledge that I can share with you. I don't know everything. I don't claim to know everything, but I'll definitely help you out where I can. My experiences, I'll share my experiences, what I feel works. I also run Traders Mastermind, so I'm involved with other traders who are developing and see what works for them, and I can extract stuff that's helped me and is helping these guys, and together we can kind of just become better, and that's my objective. So I'm going to go through today in a moment. The topic at the end, there'll be a Q&A. If you've got a question, feel free to fire it at the end. You can probably put it in now and I'll get to it at the end. The box is there somewhere. I'm sure you can find it. If you can navigate around a chart and you can trade a 1 minute price chart, you can definitely find the Q&A button. Okay, so let's get started, ladies and gents. So as a reminder, please, very, very risky trading, especially if you're trading on margin, especially if you're trading leverage, especially if you're trading a spread bet product, a CFD product. You know the score. Hopefully you know the score. If you don't, double check. But if you do, you know how the game is played. Okay, so designing a customized day trading playbook, part 2. Last week I talked about part 1, obviously, part 1 last week. And really, I was digging into kind of the process of how we can really declutter our minds, and how we can really get the knowledge that we've accumulated over the years of trading, or months of trading in your case, or years, whatever it may be for you, and just start to get some clarity in that. So we're going to go through this modular process, recap in a moment of what we've covered briefly, and then we'll go on to the next level and how to fully build that customized day trading playbook that suits you, not for someone else, not out of a book, but something that suits you, the way you trade, the way you like to trade, the time you've got available to trade, all those things. Okay, so I left this quote up. I often change these quotes, but I left this quote up because it's so true in trading. Your results are the product of either personal focus or personal distractions. It's so easy to get distracted in trading, shiny object syndrome, shiny strategy syndrome, get bored, overtrade. If you can just keep that focus, that's part of the battle. That's part of the battle. All right, so recap, the trader's challenge. So trader's challenge is this: your mind is cluttered with too much information, no real plan of action or process, or half a plan. You stick to it, you break it, and you kind of have these just going around in circles. And I liken it to, I don't know if I used this analogy last time, I liken it to, an oil tanker that's just got a little bit of rudder on, and it's burning fuel, but actually over time just comes right back to where they started. Like, hang on, I burnt all that fuel, it's taken me all that time, I spent all that energy, all that money, and actually I'm exactly where I started, because I didn't realize that I was actually going around in a big circle. And that's because I didn't have a direction, didn't have a plan of action, didn't have a process. And so we're going to fix that. Part 1, we covered a few bits. And before we get to that, the solution. Let's keep this in mind. By the way, the reason I'm recapping this is I want us to have a North Star that we're all leaning on, right? We're all heading towards this North Star. And this is to get this solution, to get that playbook, develop it, so it's personal for you. We defined our focus goal, build that clear structured trading process. We want to create a repeatable trading methodology and gain clarity in our trading, right? Last week, we talked about the decision-making flowchart. So we're putting these modular approach, calibration to conditions, construct the daily roadmap, generate your trade ideas. By the way, if you want to replay from last week, Pepperstone will send you a replay. I think it's also on the Pepperstone YouTube channel as well. There's a bit of a delay with that, and you don't get some of the bits that you might do if you're coming live and if you're registered for GoToWebinar. But check that out if you haven't watched this. Watch that one. And this will make sense still, but you need to bolt that one on to get the full picture of what we're trying to achieve here. So today, we're going to talk about trade triggers, mean reversion plays, of how to kind of set these trades up, the momentum ignition, clues, and just really how we go to the next two modules. So we set the calibration, we have our trade ideas, and now what do we need to see before we actually risk our capital, right? There's a few more steps we need to take there. Share with you some risk management tactics, and I've got a copy of the exchange I indicated I use to help you calibrate. So it kind of visually represents stuff on your chart to make it quite easy for you to visually see, hey, my calibration process is looking at prior range, Asian session, overnight session. I can see this very easily with that. I'll give you a copy of that at the end. All right, so homework. Did you do your homework from last week? Last week's homework I set was constructing your personal pre-market process. So how do you calibrate to conditions? What's your checklist? Doesn't have to be much. Can be a look at the overnight session, a daily chart, look at the engine of the market, and look at upcoming economic calendar. We talked through lots of stuff last week, but what's it like for you? There's no right or wrong. Like what might work for me doesn't necessarily work for you. You don't want to do something just for the sake of it. And then what's your trade idea generation process? And last week we talked about chunking the average true range, using that as a kind of tool, then overlaying key levels of support resistance, and considering those as an area to do business. Are we going to do a deal at that level or maybe not? Today we're going to talk about when we do decide to pull the trigger and make the deal versus when we let it go and maybe we'll look for another trade. Okay. And I did also mention to align it with your trading goals. Very important to figure out what you want to be as a trader. Maybe some of you watched that YouTube video I linked to before, which was kind of really visualizing the trader you want to be, thoughts, outcomes, everything. Because again, like the ship who's got a little bit of rudder on, just goes around in a big circle in the Pacific, you just don't get anywhere. But if you have a North Star, you have a heading you're going to, then every little decision you make is putting you on track for that. And, we don't just want the goal of want to make money. No, what type of trader do you want to become? How's it fitting with the lifestyle? All that type of stuff. So that's another topic, but it's important to discuss it now before we dig into the weeds and really understand some of the tactical stuff. Okay, so let's assume you've calibrated to conditions, right? You've generated 1 to 3 trade ideas. What now? So you've done the first process we talked about last week. What now? What the hell now, Mark? I've done all that. Now what? You need to now decide under what circumstances you will or will not take a trade, right? We're anticipating, not reacting. We're a general in charge of the whole army rather than being on the front line. So we're observing and we're trying to make these chest-based decisions. What's the opponent going to do? Otherwise, what's the market going to do? How do I want to counteract that? Where do I want to be positioned? The whole key to this is the whole reason we're doing this is to give ourselves clarity and focus in our process and develop a system that can be repeated day after day after day. And I'm not saying the setup's going to occur day after day after day. I'm not talking about system as in a trading system, but a business, a business model that goes, hey, I do this, I do this, I do this, do this. So now we need to know, do we want to take the trade? If the price is getting to that level we predefine as an area we want to consider doing business at, do we even want to take the trade? Why do we want to take the trade? How are we going to manage the risk? So let's just go through those processes now. So last time everyone laughed at my little toddler drawing of crayons here, which is we're mapping out our ideas, right? We're saying, okay, and this really helps. I know this is stupid and you can use the ghost feed. We talked about that last week. You can do stuff to make it a little bit better, a little bit more adult, shall we say. But all I'm really doing here is having some ideas in my mind of how price could get to a level, what price could do. And this might not happen, right? And again, we'll talk in a moment how we recalibrate to the conditions. But what this does is it starts to season your mind into seeing and anticipating how price could get to a level. And so you're ready for it. You see it do this. You're not suddenly shocked. You don't get seduced by a candle suddenly spiking off and you jump short because you see momentum. You think it's going to fall to the floor. No, you're prepared. You kind of see and you can see how price potentially could get somewhere. So we start to map out our ideas. Right. So we've identified an area to potentially do business. And let's assume we want to consider getting long at that 14,815 level, right? Which was that level back here, 14,815. And we actually had this is not a great chart to use. We'd actually looked before and gone back and realized that was a prior key level. And we'd extrapolated that out with the average range. And we decided that was okay, an area we potentially want to do business. I don't want to go over old ground too much, but if you saw that, we'd get it. And it all makes sense anyway if you haven't. So what now? What are our choices? Here's where it gets interesting, right? Let's imagine that's a level to do business. It's support. It's a range expectation. So stuff's fitting in with calibrated conditions. Tick, 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 tick. Now, what do we do now? The first option is option A. We leave a resting limit in with attached brackets, i.e. take profit, stop loss. Now, before I dismiss this idea, and this is not what we're going to focus on at all today, just to get that clear. However, if you are a trader who is really kind of just mind boggled with all the stuff going on, you're trying to get this working, you're just struggling, and it's a noise and it's a mess, there's no clarity, there's nothing wrong with stripping everything back and just starting with one brick. And that one brick is, what are conditions doing? Where's a key level the market could bounce? Let me leave a resting limit in there with a stop. You're not going to be able to finesse this. You have to use a percentage of ATR or a fixed stop and a fixed target 2-to-1. It's very dirty. It's very simple. But if everything is just so much noise, so much nonsense, then starting with that's not a bad way to go. I don't think that's how you're going to end up trading. I think you'll want to be able to manage things a little bit better, be a bit more cognizant of price action and all the stuff we're going to look at in the next couple of slides. But I don't want to poo-poo the idea. I want to say, hey, listen, if everything's really struggling, then just getting an idea on conditions, getting an idea if you want to get long at support or short at resistance, and that's normally in line with the higher time frame trend, picking a key level, sticking a very, very small limit order in there with an attached stop and take profit, and just running with that for a week is sometimes all you need just to get a process, a repeatable process. You don't care what you're going to make. You don't care what the outcome is. You just want to start somewhere. So I'm not saying don't do that, but we're not going to focus on that now, but it's something to consider if you need to kind of reset. So anyway, B is what we're going to run through, and that's building a set of variables that must be met as we get to that price level. All right, so some key questions to ask here. And let me go back on this. Yeah, some key questions to ask. The little guy threw me off. The little weird clip I've got in there threw me off of, it's exactly what a trader looks like. Long or short? Yeah, so how did price reach our level? What was the context of price? What was the pace of price getting to our level? What time of day are we? What happened to price prior? You need to come up with your own questions, right? I have my questions that I know that I run through and I decide, hey, how's this trade looking? How has price got to there? Because the reason we're asking these questions is and I know that the way price gets to a level can be very different. We can be grinding, slowly hits our level. We can spike straight to at the open. We can go just short, bounce, come back lower and tag it. Very different flavors and very different ways that we might want to consider getting involved, right? You can already probably think in your mind, hey, if it's a trending day and it's grinding down to a key level, I don't know if I really want to step in front of it. Volatility's low. It's got its grind on. Those grinding trend days. Don't want to step in front of it just straight away. Probably not. If it kind of spikes to it, real big stretch, 50-minute candle, has multiple 5-minute candles and one last big flush candle and hits it, and that's one of those we're going to talk about in a moment, you might want to take it. So the context is important. Is it driven by a catalyst? Is it driven by a heavy gap on news? What's the angle of the trend? What time of day are we? If it's lunchtime, generally that will be a time when we consider taking a reversion trade, because if we're talking sort of 4:30 to 6:30, or maybe 5 to 5:30 UK time, often we get a counter rotation move in the US market. But your market, right? Depending on what market you're trading. Is it the Asian session you're trading, USD JPY? Is it this, is that? These are all important things to ask. Now, one thing to point out is to not overthink this, right? I don't want to get to a situation where you've got reams and reams of stuff and you're thinking more is better. If I get all my ducks in a row, I can't lose. You're never going to get that. You have to just have that 80-20 rule of, okay, listen, what's the most important factors here? Speed of price, daily context, time of day, that'll do me. But just understanding, the key questions that are important to whether you want to take this deal or not. All right, so let's look at some examples. Different examples for reversal patterns that we might see. And again, these are not revolutionary, but what we're doing is what I think is revolutionary, if we call it that. Maybe that's a bit bold, but is the modular approach to the calibration, the trade idea generation. It's taking time. It's playing chess. I say this, repeat myself a little bit, but you're playing chess here. You're anticipating. You're not getting sucked into anything. You're anticipating. And now you've got your level. You think there's a good chance we can reverse there. You're not going to step in front of a train, but what do I want to see? So now you come up with your filter process, what's called a filter process. And the final piece of the puzzle is the trigger. So we have that filter, then we have that trigger. So a filtering process is kind of some of the things we want to see with price before we even consider taking a trade. This isn't the final part, but it's something we want to see. an idea is this: reversal 1. So we get a kind of retest. So the price comes down, level gets tested once, it bounces. This is important. Again, it's kind of how I like to approach things. You adjust it to suit you. You add your own filters to suit you. I just want to share with you things that I think are valuable, and you can discard them, add them, tweak them, make them your own, because that's what trading really is all about. So level gets tested once. Okay, fine. I don't want to be the first person to buy that level in this scenario. Next scenario, we'll talk about when we wouldn't want to be the first person. Level gets tested, it bounces a bit, and that's important. And I think people miss that a bit, in that the level bounces. And listen, if it does a V-shaped reversal and shoots off to the stratosphere, then so be it. You've missed the trade. That's fine. I'd rather miss a trade than getting a trade to get stopped out. It bounces, indicating some buyer interest. That's the important part, because if it bounces, you're showing that, hey, there's some demand there that's outstripping supply. We see a bounce, and we want to see the retest again. But this time, I want to see a bit of duration in between. So I want to see like just a 5-minute bounce and straight back lower. That's indicating there's not much buying strength there. Sellers are still very, very aggressive. Whereas when you get a test, bounces up, does 15 minutes or so, if we're talking intraday, comes back and retests, that's a bit more interesting. I've seen buyers already there. So now I'm like, okay, now we're formulating a bit of plan. Now we're formulating something interesting. I need to see some level of demand at my level before I'm looking to initiate a trade at that level. Again, very personal. This might not be for you, but I like to see duration in between in terms of time. I'll look at a chart example in a moment, by the way, and some reasonable push up. So not just kind of hovering just above the low, sorry, but I want to see something that indicates that supply demand shift, rotates back down, fine, because that's going to give me an opportunity to take the second test. And then we had a trigger onto that, which we'll look at in a moment. So example here, I think this was Q's, which is the NASDAQ ETF equivalent. Doesn't really matter the market. Just it was a recent example to show you in the real world. It wasn't perfect, actually, because we had 3 touches, but nothing is ever perfect. And it's better to include recent examples than to pick something back from 1904. Look at that, perfect chart. Yeah, great. Everyone can do that. So we get the first touch. And assume this is a key level we've extrapolated out from before. First touch at 308. We don't touch again until 35 minutes. So this is perfect for me. Now, we did touch again and the third touch, which would probably make you go, oh, we're going to get stopped, and you may have got away with this one. In fact, you did. But the important is that first touch and the second touch. You've got 35 minutes in between that, which is a good time. You've had a good kind of dollar move up from 308 to 309. So it's reasonable. It's not just sat there and 10 cents above that low. You've had some level, some sign that indicates there's someone there who's willing to buy, or at least outstrip the sellers. Now, for every buyer there's a seller, so we've got to be careful how we frame that. But the demand has come in as more aggressive, lifting offers. And then when it retests again, now they're getting a bit more interesting. We'll talk about triggers in a moment, but I want to kind of share that concept. Now, a final tick for me on this is the time of day. Now, I think I've done something exclusively on time of day before. If not, I definitely will, because it's so important. In fact, one of the podcast episodes I did on the Traders Mastermind podcast, Developing Trader, I think it was called, if you put Developing Trader DAX Trader, then it will certainly be there. But as a trader who trades the DAX, it's a funded trader actually with a prop company. And, you know, we've worked together on bits and pieces, but he really looks at time of day. And actually, I think if you're not looking at time of day and understanding, you know, when breakouts occur, when kind of counter trend moves occur, and the tendencies we have, you're missing out. And it's an easy thing to do. You're probably already doing it, right? Maybe I'm selling you something you already know. That's fine. But if not, then really go away and look and say, actually, you know what? We do have this time of day tendency. And I remember going and speaking to a prop firm. Oh, this must have been 12 years ago. And one thing they were just training their guys was in Vegas, by the way, and I live in the UK. Flew out to Vegas, see this prop firm. One thing they were training their traders was something called noon balloon. And it's where price would often spike right into different market conditions back then, of course, spike right into that high. And they would be trading all around this. So something very simple like, hey, you got to get out of your positions at noon. You got to initiate shorts in overextended markets at noon. It was all based around time. And it happens now still, maybe not so prevalent and not so exaggerated, but we still get a scenario where, you know, markets do rotate at the same kind of time of day. So maybe this is off piece and off topic slightly, but maybe go away and look at the market that you like to trade, as a currency pair, commodity, index, whatever it may be, and just kind of look and study and observe and write some notes as well, forward testing, but noting down times a day you get those rotations. And so for me, big tick in the box here. Hey, we're extended, we're at the level, we've had that sort of significant 35 minutes until the second touch. I want to see that. I want to see some strength. The boxes are being ticked now. This is interesting to me. This is something that's really kind of floating my boat. Okay, so that's one way that we could now have that trade pass through the filter. Don't think we've got a trigger yet to come, but we're having this filtering process. We calibrated, we came up with the trade idea, the key level, the extension of the range, and now we're seeing price doing what we expect it to do. Things are lining up, things are looking good. Okay, so another example for you. So you've got two. There's plenty of ways, by the way, that you can have these filters, but I just picked two sort of simple but effective ones, I feel. One is the speed of test. So notice that one was a grind, lower, right time of day, one test, bounced off, a decent duration in between the second test, came back, tested again. That's when I'd look for my trigger. Again, we'll talk about that in a moment. That's when I look for my trigger. Okay, so it's tick, 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 all looking good. Another, price doesn't always do what I want it to do, right? We can have all this, it can be too perfect and it doesn't do it and you go, oh, it's not done it. That's not really what we want to do. We want to have a few ideas and a few ways to play the idea and the theme and the thesis. Another one is the speed of test. So reversal number 2, as I call it, really great at naming these things, me. Reversal 2 is kind of when you get a real relentless fast drive towards a level. And it's exhaustion type move. You know what exhaustion kind of looks like. It's that speed, it's the pace, it's that really aggressive angle. If you stick something like a 5-period moving average on it, it's almost extended away from that. It's a real supply-demand imbalance. Very quick direction. Now, if this is driven by a catalyst, all bets are off. We're not interested in that. If it's a repriced market, as in news has come out that revalues in people's minds what that price should be, that's different. But if this is like just someone dumping a load of futures contracts or having to get a deal done quickly for no real apparent reason, we see this quite a lot. Big bursts, 15, 20 minutes, they just sort of peter out and do nothing. This is another good way to potentially consider the trade and say, hey, the filter's met and now need a trigger, but what's the filter? So it has that relentless fast drive towards a level and it's exhaustion type moves. The last candle, decent range, high volume if you're looking at volume, and an expectation that, I should probably kind of visualize this a little bit better for you, but the way I look at this is, that there's a spring, right? On short-term basis, that spring's doing this. Can I see that on the camera? Yes, you can. That'd be great if it was off camera. You're going, what the hell is he doing? There's a spring, right? You've got to kind of, it's going backwards and forwards. Market's rotating up, contracting, finding an equilibrium. Not necessarily going back to the same point, but finding an equilibrium. It's stretched, comes back, the spring goes back to normal. Stretches, comes back to normal. Stretches, comes back to normal in both ways. So being kind of normal would be the mean, okay? And very often on a higher time frame, we can be stretched. And on a lower time frame, we can also be stretched. So our expectation now, we might need to get a short-term contraction in the spring, a kind of short-term mean reversion trade. But what we're trying to do in a line here is say, hey, our key levels on the daily chart are when we think the spring is stretched on a daily level, right? Because those are the levels that we've picked up, key levels from before. They're the average true range level as well. So that's possibly going to be, again, possibly, we've got to manage our risk here as well. But that's where we think the spring could stretch and snap back. We don't think it's going to necessarily snap back and take out highs. We think there's a trade idea there, trade opportunity. And then we layer in intraday spring being stretched. So now we've got at the level and we've seen a very, very quick movement. We see people hitting bids, hitting bids. Then we, at the strong level, we expect there to be some demand coming in. Bang, we're expecting the spring to contract after that extension. That makes sense. I've visualized that okay for you, but that's the way I think of it in my mind. Maybe it's just my mind trying to make sense of some tape movements and stuff, but I really think that that's a good way of thinking. Stretch spring, you're trying to find that point where if you let go of it, it's going to snap back. Now, it might just snap back and revisit, and you might have a trend type day, fine, and you might just constantly stretch, and it might be a very short time where it's actually in the contracted phase, but we're trying to align when it's running into that level and it's very, very quick. Let's look at an example. Enough waving hands in the air, Mark. You've got a screen here. You could use this much better, much more effective. All right, here's an example here. So we had this open, this was the other day. If you guys are watching this was the NASDAQ the other day. And let's say you've got that key level, market, pre-market low, reasonable support level as well, sort of early on before the just before the European session opened at 8 o'clock. Off we go. Now we rallied hard, and all of a sudden hammer just came down at 2:30. The hammer came down, 2:30 US Open, hammer came down, and we had a really big, kind of large movement in a very short period of time for no real reason, right? There's no news, there's no this, there's no that. It's against the counter trend. There's lots of reasons to think that this isn't sustainable. Yeah, and appreciate looking at this with hindsight, but hopefully you can see how if you're looking at the hard right, the chart, and you're prepared, then you're in a good position to capitalize on this. Now you might say, oh, I would prefer to get short. That's fine. If your idea was getting short, then you get short. But we'd already decided we want to get long at this level. We've done all that pre-market prep. So we're looking at two different ways we could get long. One of them is if we hammer straight to that level aggressively. Now, I admit that it may not have been low enough for you to take this, but this is real world, and you might have gone, I want a little bit more. I want a little bit lower. I want it just to penetrate that 15,140 and then turn. But the example is valid because it's recent and it has the price action here of aggressive, very, very quick move that is not really sustainable. But if it is sustainable, we've got to stop. But we're taking let me rephrase that. That's an incorrect way of looking at things. The market can do anything, right? But we sometimes look at the market and go, hey, that's unlikely to happen. If it does happen, I've got a stop loss. And that's what we're going to talk about stops in a moment and how we initiate the triggers. But actually, it's an unusual characteristic, and I don't expect this to continue. I feel like this is a short-term edge, and that's what we're trading on, right? We believe there's short-term edge. I feel it's a short-term edge, very, very quick movement. We've had, $140 movement down to what's a significant level. The spring is stretched. It's happened in a very short time frame. The angle is aggressive. That looks like a good place to initiate. But don't forget, we haven't just come up with this from nowhere. We've already calibrated conditions, decided we want to be long, decided where the ATR range is going to be, decided where the key levels are. There's lots of work that's gone into this before we decide to pull the trigger or not. So this is another way of looking at it, the speed and aggression of just running hard into a key level. So range one was that multiple time in between the test. And you could argue this was a bit, in a way, actually, later on at 4:30, you had that right sort of time for it. We had that sort of secondary test. But I wanted to show you the speed that was more interesting for me in this one. So now we need a trigger. You've got a filter. And I gave you two examples there, range one and range two. What a brilliant name, you genius. Range one and range two. I'm more interested in the price than actually calling them fancy stuff. Maybe I should get someone to come up with fancy names for things. But you see the difference. There's a certain distinction. And you come up with your own of how you want price to get to a level. So calibration, levels, filters, we met, tick, tick, tick. Now we need a trigger. And I like this last binary event. Bang. X plus Y must occur for us to take the trade. It gives us that final nod to take the deal, and it helps us quantify the risk. So, final piece of the puzzle, the trigger. And the reason, by the way, I came up with these triggers, and I like to use this filter trigger process, is that very often we'll see price doing something we want. Okay, let me go back a little bit here while I'm on this topic. We see that, we're like, oh yeah. But if we didn't see a trigger bar, then we don't take the trade because the trade could keep going. So this is just one extra thing we like to see to help us just time the trade a little bit better, and most importantly, quantify the risk. Because sometimes these trades are a little bit like standing in front of a train, right? They are sometimes a little bit like, can feel like that. It's not. It's very different from someone just going, oh, I think this is the end of the trend, long. Very, very different because you've calibrated conditions, you've got your levels. There's a reasonable expectation there, but it can feel a little bit like, oh, yeah, everyone's selling this and I'm buying. That's why we have the trigger and why we kind of quantify the risk on that. So let's look at the triggers. So one of them, I'll give two for you. Again, trying to give you just a couple of ideas. You can go away and maybe add bolt your own in. But the real concept here is the modular approach. That's the thing I want you to take away, not necessarily how to enter the trade. Ignition bar. Say that again. An ignition bar. Why don't I just relax a little bit and be a bit slower talking, and because I've got so many slides to cover, guys. I'm looking at the time thinking, I haven't got so much stuff. I'm trying to ram all this information at you. Ignition bar. So an ignition bar is when we have something that indicates a short-term reversal in price. So we have a move lower, 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 and then it comes to our level, let's say. It comes to our zone. And then we see things flip. And this is where the short-term trader has edge, right? Because you're at the screen observing this. You see price hit that level. You see now the response. Now, this is when you go, okay, I want to see the filter. Imagine this was, okay, this could be a reasonable kind of thing you're looking at. You've got your level, first touch, got a bit of time, 30 minutes or so until the next touch. Touches again. How do I take this now? It's a level I want, or what do I do? We wait for an ignition bar. An ignition bar is something where you have an unusual, okay, you can probably see an ignition bar, right? We use eyeball very often. So it's sometimes very hard to qualify what that actually means. I guess a good way of thinking of it is an unusual bar that's against the trend that looks very different to the others. Now, not the algo guys out there and systematic guys go, oh, no, you've got to have this range and it's got to be this and that and the other. Listen, we're discretionary traders, most of us here. You just know that that's a very different bar and it's come off the low and it's something that you've waited for and it's something you want to pull the trigger on. Now, the downside of the ignition bar is that you can be late to a trade. It can be late. So let's look at another way of getting in trade. By the way, this is, again, you deploy the right tactic for the right conditions. If you feel that actually I want to wait for ignition bar, there's plenty of upside here, I can wait for a 5-minute close and get a decent strength move and be kind of one of the first movers, not the very first, and I can place this trade. Now, the good thing about the ignition bar is where would you put your stop? Now, the obvious place is under that low. If you're buying on a close of highs after you've seen all the context stuff line up, you can put a stop below the low. So it's a very easy way of quantifying the trade without thinking about, oh, where should my stop be this? Because the theory is, or the thesis is that, hey, this level is going to hold, number one. Number two, that ignition bar is the start of a buying frenzy. So really, if it comes back below that low, I'm wrong. The thesis is wrong. And the whole point of a stop loss is to go somewhere or put the stop somewhere where the thesis is incorrect, right? That's all we're trying to do. And so under that ignition bar is a great place to put it. Okay, so another one I wanted to include, which is a little bit tighter and cleaner. And what I actually, if I'm honest, I prefer this to the ignition bar. Under certain circumstances, I like to wait for the ignition bar. If you're really kind of feeling counter trend and you kind of, I need to see some strength there. I can't just be buying this on lows. It's a little bit more trending than you'd like, not as rotational as you'd like. Then you might want to wait that ignition bar and sort of play that game. But a low break fake is a much better one for me that I prefer. And by the way, from my daily email list, tradesmastermind.com/ I want to say email. I send an email every day, idea, tactics, something to think about, something to ponder. And I think last week I sent some more, maybe it was yesterday actually, more detail about this low break fake. So it's in my mind and I'll share it with you here today. This is a very, very, again, binary. It happens or it doesn't. And that's the key with the trigger. Your filters can be a little bit fluffy, if you like about 30 minutes in between the low. You can kind of look at it and squint and go, oh, add some discretionary element to it. But the trigger has to be a yes or no. And that helps once you've done all the work and you've added your intuition and the layers and stuff in. The final thing is just, it is a trade or it isn't. I'm either pushing that button or I'm not. So a low break fake is very similar to that. A low break fake basically says, once the low has been put in, if it subsequently breaks that low and then comes back above that first low, there's your entry. So if you look at the bottom middle-ish, little small, really useful small size I put there for you. As you come back through that, the first low is put in, that's the first red line that goes right back to the left. As you come back through the low again, you come back up, that's when you take the trade. So as it comes back up through, you take that trade, your stop goes below the low. A little bit more aggressive, you can get whipped out a few more times on this, but it's a defined trigger. And most importantly, it's got that quantified stop. Because I feel like that's the danger we can fall into as traders. We can have a trade that looks great, it ticks all the boxes, we take the trade, we feel like we should be managing the risk, and we end up putting that stop too damn tight. And then we go, oh, should I have a wider stop? Should I not? The beauty of it being fixed, if it's tight or not, is that you can just deploy it and go, hey, I might get whipped out a few times on this trade, but actually, if I get it right, I can get 5-1, I can get 10-1, I can hold it for multi-day move. I'm trying to kind of look for an intraday entry with a sort of swing trader's exit, whatever it may be. But I think that quantifying that so there's no ambiguity, and it also helps if your discipline's not quite there to be very fixed with it. Take the trade, ignition bar, stop goes there, don't touch it, walk away, don't want to touch it, or get the low break fake, take the stop, put the stop in, sorry, take the trade, walk away. It helps you operate like that. And just as a side note, I think I mentioned this last week, if your discipline isn't on point, deal with that first. Know all this cool stuff down, this modular approach to strategy and developing a roadmap and a playbook, because it's important. It will help you. But if you can't stick to what you say you're going to do in the heat of the moment, I can give you where the S&P is going to close at the end of the day if I knew it. And, you might still end up getting stopped out because we can't do what we say we're going to do. So you just think about your discipline and make sure that's on point before you deploy anything. Side note, but I want to mention it because I just want you to become a better trader. And I know that actually working on that is the biggest domino that will help. This stuff is really valuable. I feel it's really valuable and will really help as well, but only if you can deploy it correctly. All right, so that's the low break fake. Now let's expand on that trade that we'd had from a few slides ago. I want price to touch that 14,850 level. And I'm going to use I've got a chart example in a moment. Let's have a look at it. There we go. Better to do this and then go back. So there's my kind of bracket level. I prefer using a zone, by the way. Use a rectangle tool on TradingView rather than a fixed line. A fixed line, there's nothing wrong with it. And maybe it's the way that I like to frame things. But I always think that anchors you in such a defined level. And price very rarely just kisses a level and goes. It's a zone. Especially now with algos, they'll lift a bid, let price go through, step back up. I feel like if you traded 10 years, 20 years ago, then the fixed levels were there because they'd just be resting bids. They'd be in the pit. They'd just be resting orders to sit there. They'd hit that price. They'd just keep reloading. It wouldn't move. Now, zones I feel are better. And they're less emotive as well in that you don't go, price is below that support. Well, 10 ticks below support isn't really below support for something that's got a 300 tick range. It's just noise. It's just people putting a few bids in. So a zone, I think, is better. So if we go back to the chart, not the chart, slide before, we want price to touch that zone, right? That's our thesis. We've gone through that process, calibrated trade idea. There's our zone, 14,800, 48.25. Bounce for at least 15 minutes, right? Arbitrary level, arbitrary thing. That's our filter. We want some sort of extension, then retest. And now our trigger is going to be, we're going to go long on a move through the last low that recovers or a strong ignition candle. So we're framing, see how the process is. Calibration to conditions, set the levels, trade idea generation. And by the way, I've just gone through mean reversion today and generating trade ideas of price that could come down and bounce off. You can do whatever you like. You might say this is an explosive market. I'm calibrating to conditions and I expect us actually, if we hold that low, we're going to break out. So I'm going to buy a breakout of prior day's highs. That's fine. You do the same thing, but you just structure it differently. But it's framing and coming up with one to three trade ideas for the day that really help you. All right. So I've got my filter. I know what I want to see. And now I'm going to enter long. My trigger, my final piece of the puzzle before I click that buy button and go long is a move to the last low that recovers or a strong ignition candle. There's those two ideas that we covered there. You could have any, and in real terms, you'll probably have a few different filters of way price could get to the level, a few different trade ideas, and a few different triggers you deploy. And you might pick and mix depending on the conditions. You might say, oh, I need to wait for a little bit more confirmation on that. Or actually, you know what, if I wait for confirmation, I'm going to get such a poor entry, it's not going to be worth it. So that's when the discretionary element and your experience comes in and you try to deploy the right tool for the right job. Okay, now we've got the complete playbook. And it's something we can repeat day after day after day. We calibrate to conditions. So important. I'll give that tool in a moment to help you calibrate, but you come up with your own checklist. You generated a roadmap. You've identified a level to get long in this example, or a level to get short, or a level to dingle, or a level not to get involved, whatever. You've got a roadmap of where you think trade's going to go. And do a scribble like I do. Be a toddler, get the blooming brush pen out and TradingView and go, oh, I think price could kind of hover and do this. You'll be surprised at how often you're pretty close to the mark. Because if you've got some screen time and experience, you probably have a good feel. And if I said to you, and there was no money on the line, and there was no kind of weight on your shoulders to perform, and I said to you, listen, pal, what do you think, how could price perform today in the market you like to trade? You probably say, well, maybe we stagnate for a bit, maybe test some highs, we come up with different ideas. I go, what else? And they all come very quickly to you because you've got screen time experience. But for some reason, the heat at the moment, unless it's going straight to our level or acting exactly as we want with no kind of retracements or counter trend moves, we feel a bit nervous. So doing this roadmap of where the levels want to get interested in and actually coming up with different ways that potentially price could get there helps us feel comfortable in those scenarios when we see those in the heat of the moment. And that's important, and that's really important. It doesn't take long. You think, oh, it doesn't take long, but it's worth it, right? It's not something that's going to take you hours, but it's worth doing this process. There's one, there's two. Then our filter criteria example we had was two tests, like a double bottom type trade or a reversal type trade, or the exhaustion driving straight to that level at the open, whatever it may be for you. And we determined our trade triggers in that example: low break, fake, or ignition. And now we're prepared. And this is where it's so beautiful, because we're prepared and we can just wait patiently like a sniper. We're just sitting there. We know what our target is. We've got 2 or 3 trade ideas. We know what we want to see, how price is going to get to. It's never going to be perfect, but we roughly know our filter and we know what we finally want to see to take the trigger. And we're in a comfortable position. Now, a counter to this argument, to this, like, well, it's just too many ducks in a row. Well, not really, because we're being broad with our filters, right? We want a couple of ways that price could get here. And the whole point is that we only want to take it if everything's right and correct. And the trade trigger, the final trade trigger, could be anything, right? It could be, I'll take the first green, or I'll take the first 1 minute. You can be as aggressive as you want with that, but now you've got this modular approach, and you can approach the day with, your shoulders dropped, relaxed. I've got my ideas. I know what I'm going to do. I know how I'm going to perform. I don't need to overthink this. All I need to do is just assess conditions. Now, one argument, which is absolutely valid, is, what if you're completely wrong? What if your roadmap is completely wrong when you go into the day? Fair, and very often it is. To be frank with you, very often you get it completely wrong. And that's okay, because if you're wrong and the market is giving you some different conditions, because you only look at the prior day, you look at the daily chart, you look at all those things that you're calibrating to, you get much more information as soon as the market's open, right? And now and then you get a trend day comes out of nowhere, or a really volatile day that you weren't expecting. Okay, now sometimes you can preempt it and there's some clues, but sometimes it doesn't, right? That's the market. The market does what the hell it wants. Our job, number one, is not to get trapped in that. And so the first thing we do is go, whoa, hang on a second. I'm calibrated wrong here. I've got incorrect calibration. So let me readjust. Let me reevaluate. Let me give it an hour and then I'll recalibrate, or 30 minutes, whatever. Again, I have to do my process. You pick yours. But what this means is after an hour after the open, I'll look at the chart, look at the price action and go, hey, is my thesis still valid? Are my levels still valid? I don't want to look at this 5 minutes, 15 minutes. I don't want to keep doing it. I don't overthink things, but I do need a point where I need to look at it and go, that roadmap probably needs a bit of adjustment. Okay, we're a little bit more volatile than I thought. Let me extend out to levels that are a little bit further out. Actually, you know what? Let me drop the shorts. Let's look at longs that look strong. I might need to look at pullbacks to here now rather than this. We're anticipating, not reacting still, but we're recalibrating to conditions. So if conditions suddenly turn into a trend day, we have to adjust and adapt to that and go, it's a trend day environment here. Is that still something I want to trade? Yeah, maybe, but actually a better option would be now to have that prior high that we've broken through to come back and test that. And I'll still use my filters and trigger process in there. So it's a recalibration. We run through that idea generation process based on the new data. And that's our job as discretionary traders, really, guys, right? It's to calibrate to conditions and try to find the best possible place to express a trade idea. So there is that aspect of having to recalibrate, but a little warning of, please don't recalibrate every 5 minutes, because all you're doing is just chasing your tail to very short-term conditions. Give it a bit of time, except that if you've got it wrong and your trade isn't going to really be the trade you want, just let it go and say there's multiple rhythms and multiple times and sequences going to happen in the day. You're going to need to catch 1 or 2 or a couple of weeks, and things are looking good. And you're trying to increase your hit rate as well with this. All right, so the last piece of the puzzle, the modular process of calibration, trade idea generation, filters, triggers. That's the execution part. Now, I'd be remiss if I didn't mention the review aspect. So this is when we run it for 5 days, 10 days, 20 days, and you decide, and then you review. And this is why, why I was excited about sharing these 2 webinars with you, is because this is where the needle gets moved the most. Because the modular approach means you can go, do you know what? I'm not very good at calibrating to conditions. I'm misjudging that. Let me work on that. Let me go back and look at charts. Let me do some work. Let me mark up charts. Let me look at my overnight session. What bits of data am I missing that helps me pinpoint my roadmap better, or helps me come up with a better roadmap? And you focus really exclusively on that. And you leave the modules for the time being. Or you go, hang on a second, my triggers just suck. For some reason, I'm late. Okay, let me focus just on triggers. Let me go back and research the best way of getting a trigger. Are there any things I can research, like candles to get? So, you start to then bolt in different ways. And that's the beauty of this. I think I mentioned last time, if the car's not working, you don't just scrap the car and get a new one. Well, maybe you do, but you go, hang on a second, it's not working. Let me take it into the dealer. The dealer goes, this little sensor means that it's not turning over. It's going to cost you 3,000 quid or whatever the hell they charge you for a sensor these days. And you go, thanks very much. Here's my card, done. And it's working. So the same with trading, right? You go, hey, this part isn't really working as I want. Let me diagnose, let me assess and review, and let me add some fuel to that by, enough of the car analogies, add some input and laser focus into that to really improve it. And this is the beauty of this modular approach. Rather than my trading's not working, I don't know what to do, blah, blah, blah. It's like, oh, okay, do the next level, audit, review. Is it this? Is it trade calibration? Sorry, is it market calibration? Is it trade idea generation? Is it your execution, your filters, your triggers? Where is it? Document and adjust that. And this is, what you're doing. You're auditing as you go. And the important thing here is you adjust, apply pressure as needed. But what you do is you make a little tweak. You run it for 5 more days. You make a little tweak. You run it for 5 more days. You don't make big changes unless something's massively, dramatically broken. You make little adjustments. And this way you can iterate yourself to where you need to be. You can make these small course corrections, each individual module of your trading business, if you like, and just tweak, and just tweak, and just tweak, tiny little tweaks. And if you give it enough time, eventually those can all be lined up, and you can, you say crack the code. That's such a horrible phrase that, the Instagram lot use, but you get the point, right? We're trying to adjust these dials and trying to find, a point where, actually this fits and this works for me. Okay, so summary for you. Modular approach to trading, I think is worth embracing. Hopefully you do too. Your calibration, your trade idea generation, filters and triggers, then your review. Filters and triggers today, we talked about what do you need to see to execute a trade. I like to chunk them up into filters and triggers. Up to you though as well. If you want to bunch them, I won't recommend it. I think it's easier and clearer to be really defined about what I need to see price-wise and be a little bit more flexible and discretionary with that. And then a binary trigger event, which can come from some sort of candlestick pattern or high break or low break, the examples I showed you there. And then your recalibrate and review process. When do you adjust, i.e. recalibrate to conditions in the day? And then how will you review your performance as a trader? 5 days, 10 days, 20 days, etc. Okay, let me give you this download now while I remember before I take some Q&A. This is a little tool I had a developer made. I'd like to share these tools that I have made with you guys. I know a lot of you find value from them. Some of you say, hey, this is really handy, really useful. I think this is useful to help your calibration process. So this tool basically allows you to, you can see for yourself, it shows you the boxes, it highlights the areas of different sessions. So Asian session, London, New York, and has a little data box as well. So you can see the range of that session. So if you're going for your calibration process, you go, I want to see what the Asian session range was. And you see what the London session range was. So I use it as well for my indices. So I look at the pre-market for the NAS, for the S&P, for whatever it may be, and I can shade it and go, I can visually see it, and it kind of appeals to the way that I like to process things. And I had this little data box added as well that shows you everything you need in data box, including the current day's range, UTC, and the current day's expected range, or the daily ATR, which is close enough. So you can see, we know what, we've still got another 4 to 50 pips to go to get the expected range. All right, I could probably look for extensions. So you can kind of frame things what you're doing. You can download that, tradersmastermind.com/exchange-I. I've showed you how to use it. I will very quickly show you how the box looks. Those of you familiar with TradingView know how this works. You can change your session range times and colors. Default should be fine, but double check them. Change your colors, obviously, if you preference. Set the daily ATR. So when it's a data box, it's showing you the average true range, 14 or 10. Some people like a little bit longer, but personal preference on that. Toggle things on and off as you like. You can toggle the table on and off. And also you can display lines for high-low. Now, personally, the developer did this and goes, I've added this. I was like, okay, personally, I'd recommend you put them in manually. So if you want to put your New York high in, or you need London high in, then a manual line I think is better. But if you want to do auto, then it does it for you. I just feel like sometimes when you do something manually, you get a real feel for what the level means. It's just me, but I'm old school like that. I like to just put things manually, but it's like a nice visual representation. So yeah, like I say, tradersmastermind.com/exchange. That will send you to a page where you can go to Trading View and you can add it to your favorites. Any help with that, let me know. I can't support it, obviously, guys. This is something that's just a little tool that I use. I can't really support it massively, but if there's any small problems, I'll do my best to help you. All right. I hope you like that one. I think that's really valuable. I really do. That modular approach just is so effective. I think it's so effective. Let's have a quick Q&A. How long have we got? Oh, we've not got a massive amount of time. Let me find the Q&A section, wherever that may be. If we've got any questions in there, I will get to them as soon as I can. And by the way, the recordings, let me address this. A couple of you last time were mentioning you won't get the recordings. If you have unsubscribed from, these come from Pepperstone, by the way. GoToWebinar is the software that the webinar's done on now, you can see. But Pepperstone handle all the recordings and will send you a copy of the recordings. And that comes from their, I guess, marketing department. So if you've unsubscribed from Pepperstone's emails, that's probably why you're not getting them. They are eventually posted on their YouTube channel if you'd like to watch them there. I'm not sure whether they're edited slightly, or whether you missed the Q&A, or whether you missed stuff. But you can be very welcome to watch them there. Obviously, I prefer to have you live. I like it when I look at the numbers and go, actually, there are some people listening. You know, I feel like it's nice, and it's a nice way to do these things, and a bit of interactive activity at the end. I look forward to the Q&A. What have you got for me? All right, Julia's. But great quote. I was reviewing reversal strategies yesterday, including the noon blue, and it's like you're in my head, Mark. Yes. Oh, good. And good for you, Julia, because actually digging into those stuff and looking at the time of day does unlock stuff. I'm interested to know what you found with that. You say you're sorry for distracting you. I didn't look at the Q&A until now. 100% learn this from you. Brilliant. Okay, excellent series of webinars, Mark. Bunch of questions. If our daily is bullish, excellent series of webinars. Thank you, Falabella. Excellent series of webinars, Mark. Thank you very much. Appreciate that. Bunch of questions. By the way, I'm looking at my other screen here. I'm not just not giving you eye contact. I hate that when people are looking elsewhere and stuff. I'm looking at the other screen. If our daily is bullish, but our 15-minute has been bearish for 6 days, cable has been like this. What time frame trend is more important for an intraday trader catching bigger moves? Also, how does a 1 minute 15-second chart come to triggers? Are you just looking into the higher time frame candlestick pattern, then zooming to get a close look on the 15-second time frame? Let me answer that quickly before I go to your next question. I appreciate these questions, by the way, and I'll stay as long as we need to hopefully get through all them all. All right, so this is okay. I'm visualizing this now. I'm thinking of the cable chart. I'm not going to cheat and look at it. So you've got a daily chart that's bullish. 15-minute chart is pushing lower and lower and lower and lower and lower. And you're like, hang on a second, which is important? Now, this is where you need to use your discretion and go, okay, if I've got a really bullish uptrend on the daily, should I be waiting to position for that turn and looking for a a whole day move, that extension move that I think I'm going to get, resumption of the trend? Or do I want to be quick and nimble and just scalp on the short-term basis? Now, for me, I will always look to position on for a longer move or a bigger move, and I always take the daily into account. And that means that I might miss some stuff. I might see that downtrend happening on the 15-minute, and I might back off and go, you know what, I don't really want to try to capture that. I want to wait until I see a reversal. Maybe I see a low break fake on the daily. It goes to the low, comes back up, and I take maybe an opening range breakout trade on that day. I like to position more with the trend. If you're a scalper and really more short-term focused, then of course you can play that game. I would just be cautious if you're going short on that to only short into kind of mean reversion high. So rather than shorting breakouts to low, again, I guess it depends on the situation, the type of trader you are. But if it's kind of pushing lower, a pull back up for one more test lower, just bearing in mind that you are fighting the bigger trend would be my caution with that. Or you step aside and go, hey, you know what, I could just align long. There's plenty of ways I could align long. How does the 1 and 15-second chart come to triggers? are you looking? So the 15-second chart is when you really want to nail that trigger, right? And you really want to be, and again, the lower you go on the time frames, the more likely you are to be stopped out. But the risk reward payoff can be great. So if you're watching that 15-second, it goes lower, just grinding. Then you see bang, a big ignition coming up. You might, if you're a scalper, go, I'm in. If you're quick at making decisions, you might take that deal, hit it long, and then put a stop under the low and go, you know what, chance of me being stopped out may be high, but actually if this thing starts to run, I get a good close in the 1 minute, I get a good close in the 5 minute, and they're just chugging higher, then, you know, that's pretty decent. But I think that, you know, depends on how you feel about being stopped out regularly. Again, this is probably psychology aspect. If you don't like being stopped and it starts to frustrate you, then maybe just wait a little bit longer and go a little bit higher time frames. In terms of, I hope that's answered your question, Falabella. 50 pips on the GU ATR is about 80. Finally, what time frame are you looking at on the ignition bar? Personal. You know, if I'm looking at 5 minute, I'll look at the 5 minute. If I'm framing the idea on a 5 minute, so that would probably mean that I want to get a close at highs, or I want to get a move back to VWAP, so a much larger extension. And for me, it'll be a 5 minute. Context of all this: 1 to 2 trades a day, maybe 2 to 3 to moves, not a scalper. You just said you're not a scalper. Maybe I should have read the whole question first. All right, not a scalper. Get off the 15-second. Stay on the 1 minute at the very, very least. Try and make your decisions on the 5, 15, and then, you know, play from that. I think the 15-second is valuable, but it's one of those where, you know, you can get sucked into taking trades you don't want to take, and that's, you know, you don't want to be doing that. Rob Reed, good old Robert, said the webinars have been really useful. Oh, by the way, fella, I hope that's answered your questions. I know there's a lot of questions there, and I really hope that that's given you some inputs. So Rob has said, thanks, Mark. These webinars have been really useful. Thank you, Rob. Appreciate that. A great refresher and really good breakdown of filters, triggers, and entries. By the way, still holding long on NASDAQ today. Good for you. Rob is trying to hold trade till the end of the day. I really hope he does, because that'll be a good new high watermark for him. Royston's put, hi, Mark. What is your view on EAs and their success? You know what? I think it depends. I think the off-the-shelf ones, you know, how good are they? I don't know. Here's the big thing with this, Royston. If you have made them yourself, I think they can be very successful, because you believe in the strategy that's being executed, right? If you've developed it yourself, you believe in it. And, you know, if you've got a mixture of these trading at once, you're going to be more comfortable sticking with drawdown. That's the key with the EAs, because ultimately, if you've got an EA's equity curve, right? By the way, this is an expert advisor, it's like an algo or bot, you want to call it, for those of you who don't know. You're basically trading that equity curve, right? And so if it's at fresh highs, you're comfortable. You're like, I'm going to run the EA. And when it gets interesting is when it starts to draw down or stagnate. And you're still looking at the equity curve going, oh, and you end up trading it like a market. And so your psychology and stuff, whilst it's not input in every trade, it becomes in how you deploy capital in that EA. And the reason you can stick to trading the EA, and the reason you can stick to and have the confidence to sort of weather the drawdown, is your belief in the strategy, your belief in the process, your belief in that this is a robust system that's going to come good. If you've bought one, or if you've kind of done all the other things, you don't really believe in it, then this first time to draw down, you're going to be out of it. I know it's not really a question you asked, but that's the way that I look at it. I think you can absolutely code something that's profitable and has edge over time. You can have different types of edge that under different circumstances trade in different ways. We had Jared Goodwin was a guest on the podcast. You can search for his name under Traders Mastermind podcast. He trades very systematically, only systematically. Even Robert Carver's written a few books on quantitative trading, had him on as well. They run, you know, profitable algorithmic strategies, but they've designed them so that they're comfortable with them and they can sit through drawdown, and they know they're not going to blow up. I think it's the comfort and confidence thing. Beth has put, thank you so much for another great webinar. Appreciate that, Beth. Thank you. When you see an ignition bar or low break bar, what time frame would be good to use to enter the market? If you're a day trader, you know, a 3 minutes actually quite a nice time frame. You know, I know if people use a 5, a lot of people use a 1. You know, I prefer to adjust the time frame to the kind of conditions I'm in, and that sounds a little bit dodgy, but what I mean by that is sometimes a 5 minute is filtering out enough of the context and giving you a clearer picture. sometimes price isn't really that active. The volatility is a bit low, and I'm cautious about saying this, and you can fall into a trap here. But sometimes going down the time frame to finesse things a little bit clearer can be the way to go. Now, the offset of that, of course, is that more noise, more trades, you might end up get sucked into things that you don't want to, and that's not what you want to do. You'd rather take fewer trades, more considered trades. The downside, of course, if you're on the 5 minute and you see that ignition bar, then you're a bit late sometimes to the party. The low break bar, I wouldn't use it on a 1. I would only use it on maybe a 3, 5 really, because you want to see a significant low. 1 minute low is not really enough. But 5 minute low, it's had 5 minutes to put that low, and it's only put that level, and that becomes a little bit more significant. Obviously, if you're leaving it later, fine. If you're swing trading, then the daily chart, using a daily chart is fine too. The intraday low yesterday comes through the low, back up. There's your entry. That's a good way of kind of structuring that trade, and then maybe you kind of become more aggressive from that. I hope that's answered that question. All right, a few more questions if I can quickly run through these. Any time frames you monitor to generate trade ideas? My daily. This is Helena. My daily, my 15 minute. That's pretty much it. Again, putting some context into it and being, frank with you, depending on the conditions, right? If we've come into real fresh territory in highs, and the last 2 days have been trading at highs, I need a 15 minutes, fine, because I only want to look at 2 days, because what happened 3 days ago is way away. We're not probably going to touch it. If we've been range bound for 5 days, I might go to a 60-minute chart so I can see where all those levels are. So again, I might adjust just to kind of put the things that put price in context. I hope that's answered your question. Have I missed one? I think I have. Oh, Falabella says, Mark, you're the best. Thank you very much. Appreciate it. I do appreciate it. You guys, oh shucks. Now, I'm glad you're getting value from it on a serious note. This is the whole point. I share stuff with you, and hopefully you get some value from it. Jed's enjoyed them as well. Are you thinking more of these webinars going forward? Yeah, I hope so. I think we've got some more planned for you, Jed. Any more resources? If you go to tradersmastermind.com, you can either join us there. We've got a premium community. You're welcome to join that. We do coaching calls once a week. We have resources there and stuff, and that really helps you move forward. We've got a podcast, and if you like reading, got the daily email. I send out a daily email, once a day. There should be enough, bits and pieces out there, and also YouTube. I'm on YouTube. You can see me on UK spread betting. Thank you, Chris. Thank you, Royston. I really enjoyed these webinars. Thank you, Falabella. Thank you, Helena. Thank you, everybody. Let's call it an evening there. Thanks so much for your attendance and your attention, and I hope you've enjoyed them, and we shall see you again soon. Now, here's where I scrabble for the go-to webinar exit button, which is right over there in that screen. So that, guys, thanks a lot. Bye-bye.